Hey everyone, welcome back to AWM Insights. It's your Power 3, 2 CPWAs and a CFA. We are Eric, Brandon, and Justin. And we have a special episode for you this week. We are super excited to be able to actually have a conversation with the global head of fixed income at Dimensional, Dave Plecha. And just for those of you who don't know who Dimensional is, we're talking about a $514 billion firm that has really been the pioneer when it comes to factor investing and efficient market investing. And so this is going to be just a jam-packed conversation of where does fixed income and municipal bonds specifically fit inside your portfolio to make sure that you are capturing the highest expected returns. And so please welcome Dave Plecha to the podcast. Dave Plecha, welcome to the podcast.
Happy to be here.
Yeah, Dave, a lot of people refer to muni bonds out there. Everybody knows that they probably should be in their portfolio or thinks that they should be, but we'd love to hear from you. What's your take? Where do muni bonds actually fit in the broadly diversified portfolio for clients?
Well, when you think about your portfolio, there may be lots of different assets in the portfolio. I'm going to limit my discussion to the two major asset types within the public security markets, stocks and bonds. Now, with stocks and bonds, you might think of two of the major things you're trying to do with your portfolio. One of the things you're trying to do with your portfolio is to grow the assets. The other thing you're trying to do is to manage the risk. Those two working in combination will allow you to meet your long-term investment goals. So those kind of line up. When you think about the part about growing your portfolio, that's generally going to be the equities, the stock part. Those are going to have much higher average returns. When you think about managing the risk, this is where fixed income comes into the discussion. Just the nature of the securities, they have a fixed life and they have fixed coupons typically, just much, much better to control the risk. Another thing that fixed income does is generally is thought of as being a more a reliable place to generate income for the portfolio. Now, sometimes we go through periods like we are in now with very, very low interest rates, and it's easy to lose sight of that. But historically, that's been your source of a steady income stream, has been the fixed income. And for some folks, they're very interested in some stream of income that's free from taxes, either federal or state or both. And that's where muni bonds stand apart from everything else. There's going to be no security or security type out in the universe that can do that like muni bonds that generate that stream of tax-free income. So I think you'd think of muni bonds as that combination of controlling the risk, of the portfolio, but also producing that stream of tax-free income.
Going a little bit deeper, why would you say all muni bonds are not created equal?
Well, I mean, in muni bonds, just like any other bonds, we talk about two main dimensions. It's coincidental we chose that word to differentiate, but one dimension I would talk about would be term. The other one would be credit. So let's start into term. So there might be within the muni bond world, there's a whole spectrum of different maturities. That's why we use the term. So you might have very short-term bonds, 1-year bonds, for example, or longer-term bonds, 10 years or even longer. Those are going to both behave, the 1-year bonds and 10-year bonds are going to behave differently out in the marketplace because as bond yields are changing, as interest rates are changing, prices are changing with them all the time, constantly through the market. Longer bonds, the price swings will be wider for the same movement in interest rates than shorter term bonds. So that's one way that bonds are not all created equal, is that they have different maturities. Technically, we would use the term duration to describe that, but it's very closely related to maturity. Along the other dimension is credit. So when you think about a portfolio, let's say you have a well-diversified portfolio of AAA rated bonds and compare that to a well-diversified portfolio of BBB rated bonds. Now, those are going to behave differently too. Now, first I would say, the ratings themselves they're not perfect from the rating agencies, but they're a good starting point. So whatever you do, you're going to want to hold a well-diversified portfolio of them. But you will see differences in behavior between a well-diversified portfolio of AAAs versus triple Bs. And generally what you'll find there is like if the economy is going through a rough patch, you could think of '08 and '09, for example, or even the first quarter of this year where they're quite acute, you'll see extreme differences in those behaviors between. So they're not all created equal. There are a lot of other types of features that you might put on, that issuers sometimes put on, where they might issue what they call a callable bond, where they could actually call it early, redeem it early prior to its stated maturity date, and you would have to factor in other things. And there are all kinds of other features. But I think for investors, what you want to do is find your spot where you're comfortable with the risks associated, mainly along that term dimension and along that credit dimension. So even when either side goes through a sort of a rough patch, which eventually most will, that it's not so rough that you can't withstand it. So you find your spot where you can make it through the down patches and get through to the other side and collect those premiums that the markets are paying.
With the election coming up, taxes are obviously part of the conversation. Can you speak a little bit to how state taxes impact the expected returns of muni bonds?
Well, the way I would start to answer that question, I start out with, let's consider the difference between muni bonds and corporate bonds. So if I look at those two, and let's say I held everything else equal, I was looking at bonds that had the same maturity, same credit, same liquidity. The main difference is between the two, a muni bond and a corporate bond, is that feature where the muni bonds are free from taxes, income taxes, right? So I start out in a fictional world, a fantasy world, actually, let's call it, where the tax rate is zero. And you say, well, if the one distinguishing feature of these muni bonds is that you don't have to pay tax, but the tax rate is zero anyway, well, then it does me no good. So my expectation would be in that fantasy world that the yields would be the same. If they're equal on every other count and the only difference is I don't have to pay taxes in a world where taxes are zero, then I expect the yield to be the same. Now, as taxes go up from zero, then now all of a sudden that feature of the muni bond starts to have value, and people will pay up for that. And as they're paying up for that, they're bidding the price up, the yield will go down. So you'll see a relationship between tax rates and yields on muni bonds. When the tax rates go up, the yield on muni bonds go down, let's say relative to corporates of the same quality and term. Now, within the muni bond world, well, different states have different tax rates, and the same thing applies. So if I held, let's say, for example, a California bond, which has a state with a high income tax rate, and let's say a Texas muni bond where there is no income tax, and hold everything else equal, then you would expect that the California taxpayers, the residents, would bid up the price of those California bonds because they'll avoid state income tax on those, but they would have to pay state income tax if they bought a Texas bond. So same thing's going to hold when I look across states. I expect lower yields on bonds from states that have higher state income taxes because the local residents will bid those prices up, and higher yields from states that have low or no tax. And it's something to think about if you choose to hold a national muni strategy where you diversify across multiple states, that you might find higher yields if you lean more into those states that have low or no income tax rates.
All of us are trying to minimize the amount of tax that we pay in our portfolios. And just to hear about the opportunity on cash flow that is tax-free from municipal bonds, and really that you got to have a proactive plan around that. We want to make sure that you guys have the resources to actually implement this. And so we're going to be hosting a free educational webinar covering exactly this, everything about municipal bonds, how to construct your portfolio in the most tax efficient way. And so to make sure that you can register for that, head over to awmwebinar.com. Once again, that's awmwebinar.com to register. And until next time, stay humble, stay hungry, and always be a pro. The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.